Stop. It's surging after hours. Of course it is. The move coming after Tesla CEO Elon Musk tweeted, "Game stunk," with 2 exclamation points, with a link to the Wall Street Bets Reddit thread on GameStop. Our next guest believes the stock's epic move will likely signal a regime change on Wall Street. Tom Lee is head of research at Fundstrat Global Advisors and the newest CNBC contributor. Tom, welcome to the family. Welcome to Fast Money.
Yeah, thanks. I'm excited to be part of the family. And now you guys will teach me that secret handshake for free drinks.
Yeah, offline we'll do that. Tom, is there a regime change going on?
Yeah, I think GameStop is telling markets there's a really bitter pill to swallow right now. And I think it's the same pill that the bond market had to take in 2011. And if I could explain, it's, I think for the last 10 years, out of the $3 trillion that people saved, 94% of it went into the bond market, which means today households are synthetically short stocks. I think now some of that money is flowing into equities. And when money comes into equities, it really lifts all boats. And so I think the fact that we've got a class of retail investors armed with cash, and I think they're going to get more cash, and over the next 10 years, it's potentially $3 trillion in cash. It's going to change the dynamic around stocks and potentially valuation.
Can you extrapolate what this might mean to the broader markets, Tom? Because right now we're seeing it in a handful of stocks, which people may not be trading in whatsoever, maybe inadvertently in through various ETFs, et cetera. But beyond a GameStop, beyond a BlackBerry, beyond iRobot, beyond all of these heavily shorted stocks that have seen wild rides, how does this impact the broader markets?
I think in general, PE is going to go up. And look, I can give you a very concrete example. CCC bonds in 2011 were trading at 10%. And that's a historically low yield for a very junky speculative grade bond. At JP Morgan, there was no research issued on CCC bonds. And today, those CCC bonds now trade at 7.5%. So they've actually rallied monstrously further. And 7.5% is about where investment grade bonds traded on average for almost 30 years. So speculative grade bonds have become the new investment grade in terms of yield. Well, I think that's what could happen in equities, that we could see a stratification of PE. And I think overall, if people think 20 PE is expensive, I mean, in the bond market, it created took people out in stretchers who thought bonds were expensive in 2011. For 10 years, they got even more expensive. So I think PE could be a lot higher. And I think that's why you want to be synthetically long stocks for a while.
When do you think your colleagues on Wall Street, and I use the term colleagues, just, other strategists, other investment professionals, will acknowledge the power of this class of investor? Because to date, it seems like there's a little bit of condescension when talking about this Reddit rebellion. This is crazy. This is mob mentality. These people don't know what they're doing. They may not do the research. But the fact of the matter is, and I'm just speaking from their perspective, fact of the matter is, they've made a lot of money on GameStop and a lot of these stocks. And if you take a look at some of the other sort of, stratospheric rises that we've seen in the past couple of years, whether it be a Bitcoin or a Tesla, the retail cohort had gotten these stories right from the beginning, even as Wall Street turned their nose up.
Absolutely. I'd agree. I mean, first of all, the wisdom of the crowd means price is what we have to understand. I think a lot of people think their businesses, I can tell the stock market what to do. They cannot. The stock market is telling us the signal. And if someone who's a professional investor thinks only fundamental investors trade, that's a mistake. For the last 10 years, the average stock was held for 40 seconds. No one can tell me that a professional investor is fundamentally deciding every 40 seconds what to do. I think the majority of markets is based on expectations of the future. The retail investor is having a huge impact. Of course, it's going to create, I think, inefficiencies, but those can be exploited by other investors. So I think people just have to understand this is a wake-up call. It's a bitter pill to swallow, but I think overall it's a very good force. But you're absolutely right. Bitcoin is a great example of non-professional investors discovering a market. It's now proven to be pretty valid. And what are we seeing this year? Institutional investors are buying this hand over fist in huge amounts. They could have bought the entire supply of Bitcoin in 2016 for 1/100th the price.
Thanks for being on, Tom, and congratulations being part of the team. We're lucky to have you. So you've been bullish, rightly so, since I think mid-March. Is part of your bullishness based on this PE multiple expansion, or is it based on the E expansion from a recovering economy?
Karen, it's a fair question, and I think that it's two mechanisms. Last year, we thought S&P earnings this year could be $193, which is about $20 above consensus. And if you look at how first quarter's tracking, the beat is about 25%. So, I mean, right now, earnings are tracking to be over $200 in the S&P. So I think there's a huge operating leverage story unfolding, along with pent-up demand. And then on the multiple side, yes, I think, we've gotten used to saying, oh, well, FANG can trade at a 30 multiple, but everything else should trade at 10 or 15. I think the rest of the market is re-rating, and I think FANG can obviously see risk premium fall further, so multiple can expand. I think the overall market's multiple is trending higher, and unless retail literally disappears because of regulations, I think you're talking about a multiple that could be, a 30-something PE on the S&P.
Tom, a lot of people who look at what's going on with Reddit and sort of dismiss it or say this is just a passing fad, they say it's going to end badly. So from your perspective, how does this end?
Well, I think that in just broad numbers, I think $6 trillion could come into equities from households. You remember, households control $100 trillion of net worth in America. So there's a lot of money, but a lot of it's in cash. And they put $3 trillion over the last 10 years into bonds. A big portion of that could come into stocks. But over the next 10 years, they're going to probably save another $3 trillion. And if the majority of that goes into stocks, that's $6 trillion. Mm-hmm. The stock market hasn't seen that kind of inflows probably in 50 years. So I think that we are in a time where the equity market is becoming the new bond market. It's a better source of preserving capital because bonds are much riskier to inflation. You're almost earning nothing in yield, whereas you can buy dividend stocks. So I think the equity market is going to become a lot richer, a lot more stable. Mm-hmm. And congratulations to all those people making, seeming fortunes overnight. It's amazing.
It is amazing. Tom, always great to get your thoughts. Thank you. Tom Lee, the newest CNBC contributor, a fun strat.
Thanks.
A side effect of all this, and we've made the point that if all these people who are in GameStop lose their shirts in this, this is a cohort that may never come back to the market. The corollary to that, though, is that if they make a lot of money, other people who are on the sidelines holding all that cash that Tom was talking about could be incentivized to go into the market, Guy, because they see mm-hmm. that maybe the little guy can actually win.
Yeah, it's a carry-on effect of what we talked about last year. I think we were one of the first shows that started talking about the gamification of the stock market when there were no professional sports, and a lot of those people that typically would bet on sports found their way to the stock market. We talked about Barstool, Dave Portnoy, and I think this is just sort of 2.0 of that. And listen, you want people to make money. We obviously want everybody to do really well. I think it's a tad terrifying, though, when somebody like Elon Musk makes an offhanded tweet like that. I mean, there are people that will make money on the back of that. There are also people that are going to get buried on the back of something like that. I don't think you should be glib in this environment. I know in the last 14 years we haven't been, and we won't be. And, I just think at this point of a name like that, it's much more than just retail people getting in. I have a buddy of mine, ex-Goldman partner, texting me. This is reminiscent of Tilray when you saw that huge move. And I think this is more indicative of a fund or funds blowing up more than the retail guys and gals having their way with the stock market, with an individual name.
All right, GameStop is up 45% after hours right now. Well, if you think your portfolio is immune from these wild moves that we've seen in names like a GameStop, you might want to take a close look at what you own. Take the XRT retail ETF, for example. It is up nearly 17% in a week. You might think that the top holdings in a retail ETF are names like Target or Macy's, Walmart. In fact, GameStop is carrying the most weight at 5.3%, followed by names like Magnite, Blink Charging, Children's Place, and The Real. Dan, you flagged this earlier. That's not what you think of typically when you think of retail, these names.
Not at all. I mean, Tim and I were having this conversation. He actively manages an ETF of stocks in a sector that he knows very well, and it makes a lot of sense. But when you just have these things like in an XRT, this point right here, where you have all of a sudden GameStop is going to open tomorrow, it's going to be 6% or so of the XRT, and it really comes back to kind of knowing what is in that ETF that you're trading and how it operates. So to me, this is now in the hands of those short squeeze people. This is not really indicative of a broad retail basket trading on fundamentals, and so listen, I don't get involved in these names like GameStop and everything. I think that was a fascinating quote that Tom had about the average stock was held for, I don't know, what do you say, 40 seconds or something like that. High frequency trading has taken over, but if you do want to play these names and you do actually want to define your risk or something like that, I would wade into an XRT. I would look to kind of buy puts or put spreads or something like that. That's one way to do it without getting too caught up in the frenzy here.
Blink, by the way, is an EV charging company, and it is up 659% in 3 months. Tim.
Well, again, Tom brought up regime change, and I don't think he was really talking about this. I think he was talking about retail money on the sideline. And so we spent a good time the last couple of days, a fair amount of time kind of surrounding this one. Flows over pros, or little guys and gals against the hedge funds, is yes, on some level. And I mentioned you live by the sword, you die by the sword. A lot of short sellers get very vocal out there in the press to state their point. I think you have a case here where what we're trying to do tonight is really articulate the risks. I ultimately, as an investor, believe that this riptide is something that you wait it out. And again, you don't fight it. Now, in some of these names, that all of those cliches we've heard about people remaining solvent, or not being able to remain solvent as the market becomes irrational. But the point I think we want to make about the XRT is it's outperformed the S&P by 33% since mid-November. That's not a statement per se on how healthy the consumer sector is. We spent a lot of time talking about discretionary retail or big box or things that are doing very well. But I think our point here is that the XRT, which is a massive ETF, is now something that I think actually you want to wait out the riptide. I actually think there's an opportunity on the short side. And I don't think you're going to get taken out in the woodshed. Again, define your risk, do your work, only invest what you think you can lose. But I think the move here in retail as a class in that ETF, and I think Dan is saying that as well.